Question 1. An insured has a personal auto policy with liability coverage limits of 50/100/25. In an accident where the insured is at fault, what is the maximum amount the policy will pay for property damage? A. $50,000. B. $100,000. C. $25,000. D. $175,000. Answer: C. $25,000. The liability limits of 50/100/25 refer to thousands of dollars, representing $50,000 for bodily injury per person, $100,000 for bodily injury per accident, and $25,000 for property damage per accident. Therefore, the maximum amount the policy will pay for property damage resulting from this at-fault accident is $25,000. These split limits clearly delineate how much the insurer will pay for different types of losses. Remember that the third number in split limits always applies to property damage liability. Question 2. Which of the following is not typically considered a special or open peril covered under an HO3 policy's dwelling coverage? A. Theft. B. Vandalism. C. Freezing of pipes. D. Flood. Answer: D. Flood. An HO3 special form homeowners policy provides open perils or special perils coverage for the dwelling, meaning it covers all perils unless specifically excluded. While theft, vandalism, and freezing of pipes are typically covered under the HO3 dwelling provisions, flood is a standard exclusion found in almost all property insurance policies, including homeowners. Policyholders must purchase a separate flood insurance policy through the National Flood Insurance Program, NFIP, or a private insurer for flood coverage. Always check the exclusions section of any open perils policy. If it's not listed there, it's typically covered. Question 3. What is the primary purpose of a deductible in an insurance policy? A. To increase the insurer's profit margin. B. To reduce the number of small claims and help control premiums. C. To penalize policyholders for filing claims. D. To cover the agent's commission for selling the policy. Answer: B. To reduce the number of small claims and help control premiums. A deductible is the amount of money the insured must pay out of pocket before the insurance company begins to pay for covered losses. Its primary purpose is to discourage policyholders from filing numerous small claims and to share a portion of the risk with the insured, which helps reduce the insurer's administrative costs and, in turn, helps keep premiums lower for everyone. By accepting a higher deductible, an insured can often significantly lower their premium, as they are taking on more initial risk. Think of it as your initial contribution to a covered loss before your insurance kicks in. Question 4. All of the following are elements of a legal contract of insurance except A. Agreement, offer and acceptance. B. Competent parties. C. Unilateral. D. Legal purpose. Answer: C. Unilateral. The four essential elements of a legal contract are offer and acceptance, agreement, consideration, exchange of value, competent parties, legal capacity to contract, and legal purpose, not against public policy. While insurance policies are indeed unilateral contracts, meaning only the insurer is legally obligated to perform a future act, unilateral describes a characteristic of the contract, not an essential element required for its formation. Remember, for a contract to be legally binding, it must include offer, acceptance, consideration, competent parties, and legal purpose. Question 5. An insured's neighbor accidentally knocks a tree onto the insured's fence, causing damage. The insured's insurance company pays for the damage and then seeks reimbursement from the neighbor's insurance company. This process is known as A. Arbitration. B. Appraisal. C. Subrogation. D. Salvage. Answer: C. Subrogation. Subrogation is the legal right of an insurer to pursue a third party that caused an insurance loss to the insured. After the insurer pays a claim to its policyholder, it steps into the shoes of the insured to recover the amount paid from the at-fault party. This prevents the insured from being compensated twice for the same loss and ensures the responsible party ultimately bears the financial burden. For example, if your car is hit by a negligent driver, your insurer will pay your damages and then pursue the other driver's insurance company to recover those costs. Question 6. Which section of a property insurance policy outlines the perils covered, property covered, and exclusions? A. Declarations. B. Insuring agreement. C. Conditions. D. Definitions. Answer: B. Insuring agreement. The insuring agreement is the core of an insurance policy, detailing the insurer's promise to pay for covered losses. This section explicitly states what coverage is provided, the perils against which property is insured, the types of property covered, and any specific exclusions that limit coverage. The declarations page identifies who is insured and the policy limits, while conditions describe the rights and duties of both parties, and definitions clarify terms used in the policy. The insuring agreement essentially answers the question, what exactly is covered? Question 7. What type of loss is a direct, immediate result of a peril, such as fire damage to a building? A. Consequential loss. B. Indirect loss. C. Direct loss. D. Negligent loss. Answer: C. Direct loss. A direct loss is physical damage to property caused immediately by a peril, like a fire burning down a building or a car being totaled in a collision. In contrast, an indirect loss, also called a consequential loss, is a financial loss that occurs as a result of a direct loss, such as lost income from a business that had to close due to fire damage. The key here is the immediate physical impact on the property. Question 8. An HO4 policy, also known as a contents broad form, is designed specifically for A. Homeowners of single-family dwellings. B. Condominium unit owners. C. Renters. D. Owners of mobile homes. Answer: C. Renters. The HO4 policy, or contents broad form, is specifically tailored for individuals who rent their living space, such as apartments or houses. This policy primarily provides coverage for the tenant's personal property against broad-named perils and also includes liability coverage for incidents occurring on the rented premises. It does not cover the dwelling itself, as that is the responsibility of the landlord's property insurance. So, if you're renting, an HO4 policy is your go-to for protecting your belongings and liability. Question 9. The California Financial Information Privacy Act, CalFIPA, applies to A. All insurance companies nationwide. B. Financial institutions, including insurers, that collect non-public personal information about California residents. C. Only banks and credit unions in California. D. Any business that processes credit card transactions. Answer: B. Financial institutions, including insurers, that collect non-public personal information about California residents. The California Financial Information Privacy Act, CalFIPA, is a state law designed to provide California consumers with greater control over the sharing of their non-public personal financial information. It specifically applies to financial institutions, which include insurance companies, whenever they collect sensitive personal data from California residents. This act goes beyond federal privacy laws by requiring financial institutions to obtain opt-in consent before sharing certain information with unaffiliated third parties. It's a key regulation for insurers operating in California, emphasizing strict privacy protection for consumers. Question 10. All of the following are typically included in the insuring agreement of an insurance policy, except A. The insurer's promise to pay. B. The policy period. C. The perils covered. D. The insured's duties after a loss. Answer: D. The insured's duties after a loss. The insuring agreement outlines the core promise of the insurer, specifying what is covered, the covered perils, and the effective dates of coverage. The insured's duties after a loss, such as providing prompt notice or protecting damaged property, are typically found in the Conditions section of the policy. The insuring agreement broadly defines the coverage, while the conditions set out the specific obligations and responsibilities of both the insured and the insurer for the policy to remain valid and claims to be processed properly. Question 11. Which type of authority is explicitly granted to an agent in writing, usually in the agency agreement? A. Apparent authority. B. Implied authority. C. Express authority. D. Binding authority. Answer: C. Express authority. Express authority is the direct, explicit, and clearly stated power given to an agent by the principal, the insurer, usually in the form of a written contract or agency agreement. For instance, an agency agreement might explicitly state an agent can bind coverage up to a certain limit. Implied authority refers to the authority an agent has to carry out their express authority, while apparent authority arises from what a third party reasonably believes the agent is authorized to do. Always rely on the express authority as the foundation of an agent's contractual powers. Question 12. A hazard is defined as A. The cause of a loss. B. The uncertainty of a loss. C. Something that increases the chance or severity of a loss. D. The financial impact of a loss. Answer: C. Something that increases the chance or severity of a loss. In insurance, a hazard is a condition or situation that increases the likelihood or severity of a loss. For example, a frayed electrical wire, physical hazard, increases the chance of fire, or poor driving habits, moral hazard, increase the chance of an auto accident. A peril, on the other hand, is the actual cause of a loss, such as fire or collision. Understanding the distinction between perils, what causes loss, and hazards, what increases the risk of loss, is fundamental to insurance principles. Question 13. What is the standard number of days an insurer must provide written notice to an insured for cancellation of a commercial property policy, if the reason is other than non-payment of premium? A. 5 days. B. 10 days. C. 30 days. D. 60 days. Answer: C. 30 days. For most commercial property policies, insurers are generally required to provide at least 30 days written notice to the insured for cancellation, especially if the reason is something other than non-payment of premium. For non-payment, the notice period is typically shorter, often 10 days. These notice periods are crucial to give the insured ample time to seek alternative coverage and avoid a lapse in protection. State regulations often dictate these minimum notice periods, making it a key compliance point for insurers. Question 14. Which of the following is an example of consequential loss in a property insurance claim? A. The cost to repair a fire-damaged building. B. The cost of temporary living expenses after a dwelling fire. C. The value of stolen personal property. D. The cost to replace a broken window. Answer: B. The cost of temporary living expenses after a dwelling fire. Consequential loss, also known as indirect loss, refers to financial losses that occur as a result of a direct loss but are not the direct physical damage itself. The cost to repair a fire-damaged building is a direct loss. However, the additional living expenses an insured incurs while their home is uninhabitable due to a covered peril, like a fire, are indirect or consequential losses. Many homeowners' policies provide specific coverage for additional living expenses, ALE, to address these types of indirect costs. Question 15. The Declarations page of an insurance policy includes all of the following except A. The names of the insured and insurer. B. The policy period. C. The perils covered. D. The policy limits. Answer: C. The perils covered. The declarations page, often referred to as the deck page, is the front page of an insurance policy and provides a summary of the most specific and individualized policy information. This includes the names of the insured and insurer, the policy period, effective and expiration dates, a description of the insured property, and the coverage limits and premiums. The specific perils covered are detailed in the insuring agreement section of the policy, not on the declarations page. Think of the declarations page as the snapshot summary of your unique policy. Question 16. What is the primary purpose of a certificate of insurance when issued to a third party? A. To serve as proof of coverage without detailing all policy terms. B. To replace the full insurance policy document. C. To provide a binding offer of new insurance coverage. D. To initiate the claims process for a loss. Answer: A. To serve as proof of coverage without detailing all policy terms. A certificate of insurance is a document used to provide evidence of insurance coverage to a third party, such as a landlord, client, or lender. It summarizes key policy information like the insured's name, policy limits, and effective dates, but it does not contain all the terms, conditions, or exclusions of the full policy. Its primary purpose is to confirm that coverage is in force, without needing to provide the entire policy document. It's essentially a condensed verification of insurance. Question 17. The principle that states an insured should be restored to the same financial condition they were in prior to a loss, without profiting from the loss, is known as A. Adhesion. B. Indemnity. C. Subrogation. D. Utmost good faith. Answer: B. Indemnity. The principle of indemnity is a cornerstone of property and casualty insurance, meaning the insured should be restored to their pre-loss financial condition, no better and no worse. This prevents the insured from making a profit from their loss, reinforcing the idea that insurance is meant to cover actual financial damage. For instance, if your car is totaled, the insurer pays its actual cash value, not enough for a brand new car if yours was old. This principle ensures fairness and prevents moral hazard. Question 18. All of the following are common exclusions found in a standard homeowner's policy, except A. War. B. Nuclear hazard. C. Negligence. D. Ordinance or law. Answer: C. Negligence. Standard homeowners policies typically exclude losses due to catastrophic events like war and nuclear hazard, as these are uninsurable due to their unpredictable and widespread nature. Ordinance or law exclusions mean the policy generally won't pay for costs to comply with building codes after a loss. However, losses caused by the insured's own negligence, failure to use reasonable care, are generally covered, provided the negligence doesn't rise to the level of intentional acts or gross misconduct, which would typically be excluded. Insurance is designed to cover accidental losses, even if they result from carelessness. Question 19. An insured has a personal auto policy with medical payments coverage. This coverage applies to A. Bodily injury to the insured and passengers in the insured's vehicle, regardless of fault. B. Bodily injury to third parties caused by the insured. C. Property damage to the insured's vehicle. D. Damage to other people's property caused by the insured. Answer: A. Bodily injury to the insured and passengers in the insured's vehicle, regardless of fault. Medical payments coverage, MedPay, in a personal auto policy is designed to pay for reasonable and necessary medical and funeral expenses incurred by the insured and any passengers in their covered vehicle, regardless of who was at fault for the accident. This is a no-fault coverage and is distinct from bodily injury liability coverage, which pays for injuries to third parties the insured is legally responsible for. It offers quick access to funds for medical care after an accident for those in the insured's car. Question 20. In property and casualty insurance, a peril is defined as A. The cause of a loss. B. A condition that increases the likelihood of a loss. C. The amount the insured pays before the insurer. D. The maximum amount an insurer will pay for a loss. Answer: A. The cause of a loss. A peril is the specific event or cause of a loss that an insurance policy is designed to protect against. Examples of common perils include fire, windstorm, theft, vandalism, and collision. In contrast, a hazard is something that increases the chance or severity of a loss, and a deductible is the insured's out-of-pocket expense. Understanding that a peril is the cause of the damage is fundamental to knowing what your policy covers. Question 21. Which type of bond guarantees that a contractor will complete a project according to the contract terms and within the specified timeframe? A. Fidelity bond. B. Performance bond. C. Judicial bond. D. Bid bond. Answer: B. Performance bond. A performance bond is a type of surety bond commonly used in construction, which guarantees to the project owner, the obligee, that the contractor, the principal, will complete the work specified in the contract according to the terms, plans, and specifications. If the contractor fails to perform, the surety, the bond issuer, will compensate the owner for any resulting loss or arrange for the completion of the project. This provides crucial financial security for large projects. Question 22. What does it mean for an insurance policy to be a contract of adhesion? A. The policy can be modified by either party at any time. B. The terms are dictated by one party, the insurer, and must be accepted or rejected by the other party, the insured, as a whole. C. The policy is a bilateral agreement with equal input from both sides. D. The policy only covers losses that are specifically listed. Answer: B. The terms are dictated by one party, the insurer, and must be accepted or rejected by the other party, the insured, as a whole. An insurance policy is considered a contract of adhesion because it is drafted by the insurer, and the insured has little to no power to negotiate its terms. They must simply adhere to it. This characteristic leads courts to interpret any ambiguities in the policy in favor of the insured, as the insurer is the party who created the contract. It highlights the unequal bargaining power between the insurer and the policyholder. Question 23. The California Earthquake Authority, CEA, offers earthquake insurance for A. All types of commercial properties. B. Residential property owners, renters, and condo unit owners in California. C. Only properties located in high-risk seismic zones. D. Only structures built after the year 2000. Answer: B. Residential property owners, renters, and condo unit owners in California. The California Earthquake Authority, CEA, is a publicly managed, privately funded organization that provides earthquake insurance to California residents. It offers policies specifically for residential property owners, houses, mobile homes, renters, and condominium unit owners throughout the state, regardless of specific seismic zone or construction date, though rates may vary. It's an important entity for managing earthquake risk in California, as standard homeowners policies typically exclude earthquake damage. Question 24. An agent who represents more than one insurer and seeks to place coverage with the company that best meets the insured's needs is known as an A. Exclusive agent. B. Independent agent. C. Direct writer. D. Captive agent. Answer: B. Independent agent. An independent agent is an insurance agent who works with multiple insurance companies and has the freedom to choose which insurer to place a client's business with based on their needs, price, and coverage. This contrasts with a captive or exclusive agent, who represents only one insurance company. Independent agents can often provide a wider range of options and competitive quotes by shopping around for their clients. Question 25. Which of the following best describes the principle of insurable interest in property and casualty insurance? A. The insured must own the property at the time of the loss. B. The insured must have a financial stake in the property at the time of the loss. C. The insured must be listed on the property's title. D. The insured must be able to prove they would profit from the loss. Answer: B. The insured must have a financial stake in the property at the time of the loss. Insurable interest means that the insured would suffer a financial loss if the property were damaged or destroyed. This financial stake does not necessarily require ownership, e.g., a mortgagee has an insurable interest, but it must exist at the time of the loss for a property insurance policy to be valid and a claim to be paid. Without an insurable interest, the policy becomes a mere wager and is unenforceable. Remember, if you don't stand to lose financially from a covered event, you don't have an insurable interest.